the weekly chart just to show you just you guys to give you a rough idea of what the structure is initially. But what we need to pay attention to, guys, and I'm going to just try and short form fit this whole tutorial as much as I can, but going through my general intellections as to how do I ascertain certain areas and key levels for specific influences, and then use those areas to find my specific trades, right? So all in all, this market is bullish, but it's not because that we have this impulsive move, that we suddenly have this impulsive move that we should say that it's bullish, right? We have this impulsive move to the upside that takes out this trend line liquidity. This is the most obvious indication that this market is essentially bullish, right? But this is not where I want us to start. We want to start at the beginning of the chart when the instrument was first introduced, right? So we start at the first month's candle of that instrument, and we can see it is actually a doji candle. So a doji candle, guys, if you don't know candle anatomy, you need to learn that shit. Doji candle is basically an indecisive candle, which means at one point this candle, during the month of this candle, it opened and dropped initially, and then rallied and closed somewhere near the open, right? So essentially it dropped and then it bought for it. So essentially the buyers were a bit heavy on this candle, more than the bears, but the price still remained at equilibrium. So that price point still hadn't changed even after the month had closed. So that we only had liquidity resting below this low and liquidity above that high. So essentially either one of that liquidity that gets taken will give us the general bias, and that's what happens in the following month with this pin bar candle, which essentially digs into that previous low. After digging, it rebalances that previous candle, and then it buys and closes bullishly, actually breaks structure above the previous month's high. So that's a valid break of structure. So the first indication that this market was essentially bullish is how they swept that previous month's low and then proceeded to buy and break structure on the upside. So you guys understand that? I hope you guys understand that, because there's no other way to define it really, especially when you're looking at an instrument when it's first being introduced. You need to look at the equilibrium price point as though price had used that area as a fair value. So whenever we use that area, we confluence it to whatever future moves unfold. Hence the third month. This is why the reason why I'm saying what I'm saying is because the third month, the follow-up, the subsequent month after the second one that initially shows us that first break of structure, comes back down to that low. The low that it has shut the previous month's low, they come back to it. Why are they coming back to engineered liquidity? Because that's a low that they engineered by stabbing through this low. So this is an inducement. So essentially they're coming back to take out that liquidity. It's not necessarily a break of structure in the truest sense of the form, because essentially what price does after it takes out the liquidity, it reverses. You see how it started getting into inside of a bullish market structure, and it pushed and propelled price as price surged through those highs that it had initially came from. Because this month candle, this bearish candle, essentially it rejects here, because it doesn't even close above the previous month's high, right? Even the volume of the candle is exactly at the same level as the previous month's high, right? Close. So previous month's close is exactly the same as this month's open, because essentially it drops, right? And then we start getting bullish sentiment, and essentially this bullish sentiment expands. So this entire expansion to the upside is showing that there's willingness there's still more buying that is getting instituted in this market, right? So essentially, even if you hadn't seen everything that happens all the way to the right, and we have all that information now because we have the benefit of hindsight. If this market had opened and you had wanted to trade these kinds of moves, essentially what you'd wait is for an idea that price is essentially moving around two ranges. So essentially when price digs below this low and takes out this liquidity, it's instituting that now by reversing into a bullish structure, that lower range is very deep discount, and therefore its extended leg prior to the break of structure is now the new range that we work with, right? So from this low to that high, indicated by this bullish candle right here, that is the extended bullish leg that breaks structure to the upside for the second time after they initially tipped their hand here. So guys, follow order flow, right? So when you understand that the instrument has these calibrations that it is following, it is going to be easier for you to find setups, because now you can round up or round down the numbers that are specific to the levels that you require. So essentially when price comes up to this high, it gets into a consolidation, right? First, the bearish candle that it prints rejects going above the previous month's high. Therefore, price is essentially telling us that it no longer wants to go above that high. Then it comes back with a retracement with a bullish candle that essentially initially sweeps the low of the previous month and then buys to a certain level and closes near the mean body, the mean threshold of that entire candle. So price is still being kept within a range. It's not being let to go up, but it's not being let to go down either, because essentially what they're doing, they're just sweeping. But all of this now turns into rejection, because price essentially gives us an SMS, right? It's telling us that technically it doesn't really want to go above those levels, and it's essentially rejecting. So this month, the third month, from prior to the extended leg from down here to up here, this is the first month, second, third month. So this is the third month, and the fourth month actually confirms the break. You see how even the timing is specific, how many months they take to do certain things. You should pay attention to those things, guys, because essentially the swing point from here, it only took 2 months to reverse, and then at the third month it was giving us indications that it's bullish, and then on the fourth month it actually breaks structure, showing us that it's actually bullish. So I mean, by the time you would have even gone inside of any trade here, it would have already happened. So what would have been the opportunity? You would have needed to see all of this in hindsight. And for me, I personally wouldn't have taken any trade once this instrument opened at this point, because when it's stepping into this sell side imbalance, if I'm expecting a continuation trade of this break of structure, I will probably wait for levels here to get violated first to confirm that it's actually bullish. and so it did. So I wouldn't have gotten inside of any trade, right? I would have waited for the extended leg to happen, the expansion first, and then measured my move from low to high and used that range to trade these very specific counter trends, right? So this is a counter trend trade here. You can take this sell setup, aim for this buy side imbalance here, and the low below this candle's low. And equally so, when you aim for that, you also know, right? You also know that price has the potential to buy, right? And as soon as it rejects at this level, you will find areas that give you confluence, right? Essentially, when you came and you took a trade, maybe say perhaps you took partials, although you hadn't aimed for any low, any particular low, you just aimed for that imbalance, that buy side imbalance to get closed. Essentially, what you're waiting for is to take your profits around the low of that candle, right? And once price had already give us an indication that it's actually sweeping below that low, you get out of the trade and wait for another continuation trade further down, because what you're looking for is a break of structure, right? To confirm the sell, essentially. And so if price comes back and rejects here, your levels still are keenly aware that there's a premium here and price is unwilling to get above there. So essentially, it goes into another consolidation, and immediately it taps a rejection block and plummets down, aiming for that low it just came from, going to break structure below that low. It goes and breaks structure, which means it's showing that there's momentum to get down to levels, right? So essentially, this was maybe the tip of the hand. You might have not noticed it because price essentially wicks below this low. So essentially, they collect liquidity, so you would be expecting a total sweep buy. Whereas price essentially is telling us that it's inducing more people who are interested in the buy by getting them in the market and participating early, and then they come and stop them out. And then before they stop them out, they still have another further objective to get down to, because essentially this low was an inducement as well. Remember, this low was engineered liquidity, so there is liquidity below that low. So essentially, price is trying to get down to that level by having these deep retracements on the sell side of the curve, right? On the sell side of the curve, we have deep buy retracements that, if you notice the setups in time, you can get inside of these kinds of setups, right? Essentially, here's an order block here. When price comes back, break structure below here, you wait for the retracement, get inside there, boom, sell. You don't really get out below the low, but you can get somewhere out inside of the buy side imbalance that you would have denoted by this bullish candle here, because we're still on the monthly chart, remember? And essentially, that month was actually manipulation, because what price is doing, it's rejecting, it's saying it no longer wants to go lower, because essentially they still an objective to get up to here. And essentially what they do, they come and wipe above this high and this high. Subsequently, these two highs get wiped by this third move, so it's a three drive per pattern inside of a bearish order block, and then essentially it drops for the final time, going to sweep that low, right? So all of this bearishness that took, let's count, 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15, so basically 14 months to get down there. The 15th month, that's the one they actually reversed after taking out that sell side liquidity resting below this low. So there's an all-time low. It's still a relatively big low, because that's what they were using as a discounter rate initially when they bought to break structure on the upside. But they're coming back to take out that low, and now look at what price is doing after it takes out that low. It surges, right? Showing us that there's willingness to get above to levels. So essentially, this market is a bullish market, to be honest. So I hope you guys can understand the order flow that I've just interlaid for you guys, just denoted by the monthly time frame. And remember, the monthly time frame is still a huge time frame to deal with, and you're gonna have to be very specific when you get down into the lower time frames. What exactly are you looking for, right? So I just want to note something quickly. Okay, so we have a rejection block there, which appears to be the area where price was actually essentially reacting from inside of that consolidation when price decided not to break lower. Where do I mean? I mean here, guys. This doji candle decides to actually hit that rejection block. That's why it rejected and bought, all right? But it came back for a final drive below that rejection block and swept the liquidity below that all-time low. So that's what I just wanted to note, because I didn't have that line delineating a rejection block here. So essentially, that's why price was just having all of this weighty price action here, is because essentially it's taking liquidity. It took liquidity below this low, and then it came back inside the range of that area, and then it just rejected just for another drive to take liquidity above there. So they were buying to sell, right? So that was the buy to sell scenario, and then immediately after price tags that liquidity below that low, it reverses, all right? It reverses, and it's buying, and it's inside of a bullish institutional order flow, and it's pushed above those levels here, all right? All right, so I think what I can do now is I can just drop down into the weekly and then the daily time frame. I think that will be enough for a rough idea of analysis. I'm not going to get into deep analysis like the 4-hour, looking for intraday sessions like scalpings, or on the 5 minutes, or these short-term trades on the 1 hour. I'm not going to do that. I'm just going to finish my analysis on the daily. So let's go to the weekly, because I had already showed you guys initially this. I showed you guys, so we can see all of the ideas that we have extrapolated from the monthly time frame, that essentially the equilibrium price point was here, and price essentially rallies, then drops, then breaks structure above that high, right? So essentially price rallies, then drops, right? So there's what we want, and then what we're willing to do to get it. I don't know if you guys are understanding me when I use that terminology. I'm basically using AMD, all right? Accumulation, manipulation, and distribution, right? What we want is what we accumulate. We buy first, show our intent, and then we sell, to manipulate. We take out stops below a low, and then we break structure to the upside, showing our intent. We distribute the longs that we collected here. But essentially, that whole area is an inducement because price comes back and slams right through it and takes it out. Takes out that low and says, nah, y'all thought we were selling. Takes out the sell stops below here, right? Because above the marketplace are buy stops. These are sell stops. So if price essentially is taking out sell stops, they want to counter them party to a net long position. And that's where they start accumulating once more, distribute, right? So this is, okay, so this is the distribution and exit, right? Take out the stops and then start buying, right? Sentiment is still bullish, remember. But once price had gotten to a level, it only took 2 weeks above that break of structure, the second break of structure above that high, or those two highs, because these are 2 weekly candles, those are essentially two equal highs. So it breaks structure above those, and then it takes another week and reaches terminus, right? And then it starts trading efficiently back and forth, essentially giving us a break of structure down here, change of character. It essentially doesn't want to go higher, right? It rejects that level here by creating a high with this month's candle. And then it goes down, break structure below, giving us indications that it wants to sell now, right? And then it comes back and rejects a couple of times with pre-drive pattern, sweeping liquidity above old highs, and then essentially giving us the ghost, right? Boom. And then what is it aiming for? Well, there's a buy-side inefficiency inside of this long candle. This long bar candle has buy-side inefficiency. Price essentially comes back, fills it in, and then it retraces, gives us a wipe above the range. So it sweeps liquidity inside of the range. There's a premium array inside of the 50% of that fib. Okay, so we can even grab a fib, and we can see that projection from when it dropped down, right, all the way down to where it broke structure from. We can see that price essentially comes back into 50% and 62% retracement before it goes for another drop, if you can see what I'm talking about. So essentially from this bearish order block here, which is inside of the range, consolidation breakout, right, rejection, right, price essentially comes back inside of that range and then drops, right. So from that point, from this point up to the break of structure, the next break of structure, price essentially makes another 3 drive pattern, 1 2 3, right, and then drops again, break of structure below here. Essentially, this break of structure comes to an order block, right? So it is forced to react. However, it only comes to this level to close out this sell-side imbalance that is resting above these highs that we just came from. So it only came to come and do that, clear out that imbalance, close it in, and then drop one last time for another sweep below that, another break of structure. So it breaks structure again, right, lower, right? So essentially what it does, it comes back, it wipes above this weekly high inside of the range, and then essentially it wipes again about this weekly high inside of the range. So it takes a lot of, these are setups, guys. These are lots of setups inside here. These are weeks, but there is so much that you can take from them, right? There's so much that you can do. These are swing trades, you know. These are swing trades. These are particularly interesting to me because these are the type of trades that I kind of like to hold, you know, hold for a couple of weeks and just hold these kinds of movements. The price is just being reactive and responsive to specific levels. The nice thing I like about synthetic is they are very specific about the levels. Essentially, price comes in and sweeps above this high inside of a bearish order block, right? Boom, 62% retracement, crash, right, and crash, and then essentially we sweep that low. Yeah, man. I mean, we were on the sell side of the curve initially with all of these deep retracements into premium. So premium, break of structure, retrace into premium, 50% break of structure, retrace back into premium, hit a premium break of structure. So each single time the price was offering a move to sell, people sold, right? Break of structure, price comes initially, sweeps above this high, fails to break below this low, but it goes in for another sweep above the high it just came from. So this is inducement, inducing sellers, early sellers to get inside of the program, just only to come and take them out before actually selling lower. Essentially coming below this low, didn't break structure, didn't necessarily need to break structure because it was sweeping, and essentially price reverses. So you can see price has started to reverse, and we can see that the weekly candles are stepping off of each other. So this is why I say it's probably too late to get inside of any kind of setup. The only pretty array that I'll probably, you know, wait for price to come and tag is a potential order block here, right? Price could potentially come back into it, hit it, and then push higher. That's the only one, but it has spaces above it and below it, so I don't consider it a proper. I mean, it's an order block in the sense that this last candle before the push up, there's a fair bit of gap in here. So price would probably need to mitigate that fair bit of gap, tap the body of that order block on a weekly, and then potentially push up. But the highest expectation that we have that is most unrealistic is probably the price will dig back into deep discount when it is already buying, guys. It is already buying, so there's no point. We can't chase price. We have to wait for the opportunities to unfold. Okay. So let's move on to the daily, and we can see that, I mean, essentially all the market structure that you find on the daily as well is making clear sense. It's giving you true depictions of what prices intend to do, how long it takes to consolidate around levels, how long it takes to wipe the weekly high inside of a range just before it hits a premium array, like the sell side imbalance here, which starts below this range. So price essentially hits that sell side inefficiency and then it drops, right? Because if you can see on the daily, that low of that wick of that candle and the high of the wick of this candle, which drops below, that is a balanced price range. That was buying and selling inside of there. But below that, there's just a huge space. So that's the sell side imbalance that we're noting there. We also noted on the weekly, and we have run above these highs, these collective highs, these double highs. This is liquidity. This is engineered liquidity. It was an inducement because essentially people sold there, thinking that that was the sell signal, but it wasn't. It was initially the inducement. So I mean, there's so many ways that you can, there's so many ways to read structure, guys. So here I'm just on the daily and just taking a look at all the areas of confluence on the daily that give us these nice swing setups. I mean, we could have taken something like this. Could have waited for price as well to get up into premium, right? Into premium levels, right? You could have caught the buy as well. The buy is also sweet. It's a sweet buy because immediately when price hits that area, it decides to react. It reacts, guys. So essentially, what price comes back and hits is a order block to the left. It's an order block to the left. So essentially, price hits which order block? Which order block did it hit? Yeah. So essentially, price hits this order block. So essentially, price comes and hits this order block, this specific single candle inside of the range of this. I guess this would be a weekly candle. These 3 consecutive candles here to the downside. That would be another order block, a daily order block as well, but there's another one inside of that range here, just below these lows. So price essentially hits that one, and then it starts its buy, right? So, I mean, these kind of setups you gotta wait for. You gotta be very specific about where you enter, and you gotta be very sure, and you gotta have proper risk management, and you also gotta make sure that you decipher the specific levels, right? The monthly takes precedence over the weekly takes precedence over the daily takes precedence over the other one. So even when you step up in your analysis, when you're doing your top-down analysis and looking for specific entries, you must understand that wherever you choose to enter is determined by a specific PRA, specific confluence on a specific time frame, given the proper institutional order flow in mind, keeping proper institutional order flow in mind. All right, so guys, that's just basically it. This is my analysis for FX volume 20, and I hope you guys enjoyed it. This is pretty much when I do these analysis, these rough analysis, I just start from the monthly, drop down to the weekly, then the daily. I don't really go down into the 4-hour. When I do that alone, and that's when usually I'm looking for specific entries. Right now I'm not trading anything, I'm not interested in trading anything. I'm just looking, basically just back testing my strategy and looking at specific areas of confluence that I could potentially find myself getting inside off of. So this is my video for the week. Until we meet again next time, this is your boy Prince Omari. You guys should trade safely and be safe. Ciao.